2 fewer cuts for 2024, 1 extra cut for 2025. This is the countdown to the close. The post-Fed special, Romaine Bostick alongside Alex Steele and Scarlett Fu. And Alex, Scarlett, I was taking a look at the market moves today, and I'm really curious. Is this because of the Fed or because of the CPI report?
This is Well, this is the 20-month anniversary of the bull market. Do you guys know that? Starting today. No. And from what we saw from the CPI and Powell and the Fed, and you didn't give me a gift, it's hard to see how that's going to end anytime soon.
I agree. And we have the S&P 500 topping 5,400 for the first time ever. The word of the day really here was confidence, based on what Jay Powell was saying and what Fed officials want to see more of. But that's so subjective.
Well, I'm glad you said that, though, because I felt like the last few meetings and the last few press conferences, you didn't necessarily see that same confidence. He seemed a little off his game in terms of what he wanted to communicate. He was a lot more direct and forceful this time around about what the Fed decided and, more importantly, where they see things going over the next few months.
And the thing they see is not much of anything right now. They have 1 rate cut scheduled for this year, and then next year, sure, there's a bunch of them scheduled, but that's so far off.
So that's my question now is, are we going to wait longer than to get a series of cuts, or are we going to get a cut earlier and then kind of pause and wait a little bit?
It was interesting. I was looking at our T-Live blog a little bit earlier, and Curran, who's just really kind of the best at this. He kind of raised a good point here. Do you really think the Fed can stand by just 1 cut, particularly with the market still pricing in hope for about 2 to 2.5 cuts this year?
Well, we're at a record high, so I mean, how's the market going to react once we actually get that cut and they signal that there is more to come?
I'm sure they'll take it in stride.
Or once we get the cut, do we finally see small caps getting a true bid and a more sustainable bid in the broadening out of the rally?
Well, and actually we saw that a little bit today here. I mean, the Russell has given off some of its gains, but for most of the day here, it has been the main gainer here, outpacing the S&P and the NASDAQ. So they all right now seem to be neck and neck, up about 1.5% or so, depending on which index you want to pick. Fed Chair Powell speaking a little bit earlier at the press conference. Here's what he had to say.
Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
Jay Powell speaking there just a moment ago. Barry Bannister joined us in the here and now as we count you down to the closing bells. Chief Equity Strategist over at Stifel. And Barry, I want to get your reaction here to what we heard today. The idea that the market really was primed to go higher in equities, lower in Treasury yields long before we got that Fed rate decision here. Did anything change at 2 p.m.?
Well, when the Fed said that their inflation forecast median is 2.8, up several tenths, and it's 2.8 in the April month, they're acknowledging that inflation probably stays very sticky, if not stronger, according to our models, in the second half. And as a consequence, if you go back to the 25 years, the quarter century prior to the pandemic, the highest core PCE ever got was 2.7 in August of 06. So my question is, why cut it all? Bernanke took rates then above the Laubeck-Williams neutral R-star level. Why not stay there? So I think I'm not too worried about the 2025. I don't think they're going to cut as much as they think. But the market didn't react very much at all to the Fed peeling away those rate cuts.
So, okay, does that mean that, so your view before this was you're looking for a 10% correction, right, by the end of the third quarter of this year. Do you still hold that? Because that has been a very tough view to hold, considering we're trading at 54.23 and the Fed's still talking about 1 rate cut this year.
Well, when they see the actual acceleration and probably above the Fed's own estimates in the second half, you typically would have your summer seasonal weakness. It would be the months of July and August are particularly treacherous into September, particularly July or September is the one I'd be most worried about. At that point, we'll find out what we get. But one thing to consider is that in a bull market, people tend to suspend reality. If the long-term expectation of short-term rates is going to be over 4%, that means the term premium is actually close to 0, and that's entirely too low when you look at all the deficits we have coming down the pike. So I'm a little bit troubled by the level of ebullience in the market. There's just an almost irrational level of excitement among investors. Some of it's AI, but generally, I think it's just the wall of liquidity, the wall of money out there that people are trying to get invested.
Talk a little bit more about that wall of liquidity and that wall of money that's coming into the market. Do you see a wall of it coming, say, in July when second quarter funds start coming in earnest? And how do people put that money to work when the dot plots show that the Fed doesn't know and can't give investors any guideposts?
Well, the cardinal sin of the COVID policy was to helicopter drop the money in and not actually produce any goods to generate the income to buy the good. The money has to be, you have to work to make money to buy the goods. And so we helicopter dropped this purchasing power in, got a huge spike in inflation, changed the labor market, and altered people's expectations. The general price level is marked up, and it's fairly permanent. Incomes have not really caught up, and they won't for a while. So the mistake that was made was just all the money that eventually got funneled up to corporate cash balances and wealthy people who own businesses. They got the receipt of all that cash, and that cash totals about $6,000 billion, $6 trillion. So there is money that can be put into the market to drive it to even more irrational levels of valuation. But it was entirely, we're still living with the legacy of the COVID policy.
Does any money coming into the market, though, Barry, I mean, does that necessarily have to chase the irrational side of this market? We were talking a little bit earlier about the relative outperformance today in the Russell 2000, the idea that there are a lot of small and mid-cap names, real names, valuable names, not necessarily just the dregs out there that really haven't been bought up in this rally here. And I'm kind of wondering if maybe there is an opportunity to do that now that we have the Fed clarity.
Yeah, as a long fan of dregs, I've always kind of looked for when the best entry point would be for value, for international, and for small cap, because they have lagged in a growth-led market. It's just been an area or a hobby or an interest trying to keep up with what would drive that. And what they require is much better economic growth. We're not going to see that with a PMI manufacturing under 50. And they require reflation historically. They'll also need a weaker dollar.
Yeah.
We just haven't seen much of that yet. So as much as we would like to see things like that and commodity prices strengthen, we haven't seen huge signs of that yet.
All right, Barry, always great to talk to you. Getting that instant analysis here to the big Fed decision today. Barry Bannister over at Stifel helping us count you down to those closing bells. Those bells here just about 2 minutes away here as we continue our special coverage. Romaine Bostick alongside Alex Steele as well as Scarlett Fu as we move closer to those closing bells. Our full market coverage right here on Bloomberg coming up in just a second. Don't go anywhere.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele and Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast with Carol Massar and Tim Stenovic on this Fed day here. A big rally that we're seeing in the equity markets here. A big rally, believe it or not, in treasuries, leading to a big drop in yields here on this Wednesday afternoon.
Yeah, fascinating. We were kind of all counting down to it. No surprise here. We just talked with Sylvia Jablonski over at Defiance ETFs, kind of saying a sweet spot for equities, a soft landing, like it almost feels too good to be true, and I don't know. It's just kind of interesting to see the market reaction. Yeah, we came in a little bit on stocks and we saw yields kind of bounce off their lows, but nonetheless, investors seem to be taking it in stride.
Yeah, but that tone was set at 8:30 this morning with that CPI data that came in. That was exactly what the equity market and the bond market wanted to see, Scarlett. And that set the tone throughout the day today.
Yeah, that was the high watermark for trading volume as well. If you look at average value at time of shares traded, it was really in the morning, and it picked up a little bit right when the FOMC announcement came out. But you didn't get the end of day pop that you typically see. I mean, it's certainly come back from the mid-afternoon, but most of the big news came at 8:30.
And this just goes to what Savita Subramanian said at Bank of America earlier on Bloomberg Television. Things are kind of awesome. It's a straight up Lego movie theme song. It's not totally awesome, but it's kind of awesome. And that's exactly what I feel like the theme was throughout Jay Powell's press conference. And that's sort of how the equity market seemed to react.
This kind of gets us back to that question. Is this really kind of that Goldilocks scenario, at least in the short term here? The market seems to be pricing that in here. And I do have to go back here. That a lot of this, what we're seeing in the market today, the gains that you're seeing on the screen there, a lot of this was priced in long before we got that Fed statement, long before Jay Powell took the stage. A CPI report really emboldening the bulls here on this Wednesday afternoon. The S&P 500 at a record 5420 and change right now as we wait for these numbers to settle. That's roughly about 46 points higher than where it was yesterday, 0.9% on the day. The NASDAQ composite up more than 200 points, or about 1.5%. The Dow is actually your laggard here on the day. It's going to finish the day in the red, but only by about 0.1%. And the Russell 2000, which has basically been leading the market for a good portion of the day, up on the day by 1.6%.
Can I just point out that the S&P 500 off that late December 2023 low is up almost 32%. So talk about the move to the upside. Having said that, in today's trade, I know Tim was having a hard time finding some of the decliners, but we had kind of an even split. If I look at the trade, it looks like 297 names in the S&P 500, Scarlett, to the upside, 205 showing some declines in the trade.
All right, let's show you how that plays out in terms of sector performances. You split the S&P 500 up into 11 industry groups. Because tech is the most heaviest weighted group, it's the biggest slice of the pie. That group up 2.5% thanks to Oracle. Industrials and consumer discretionary also gaining about 1%. On the downside, your laggards are energy stocks led by Valero, consumer staples, and utilities losing about 2/3%.
You have a cold.
A little bit.
Are you okay?
Oh,
Yeah,
no,
yeah.
did I give you my plague?
No.
Oh, thank goodness. Okay.
COVID's going around, so I hear.
Please don't say that.
I know. All right, let's get to some of the individual gainers, if we may. Oracle, man, a standout. We were breaking it all down late yesterday after the closing bell here, on the closing bell, if you will. The stock up, as we said, more than 13%, hitting a record. Earnings last night reported better than expected bookings, announced partnerships, deals with tech rivals, so giving a boost to Larry Ellison's efforts to redefine the software maker as a major competitor in the business of cloud computing, but investors really buying into that one. Apple, again, continuing to build on yesterday's gain of more than 7%, another 2.9% to the upside, another record close, so back-to-back on that one. A top name in the NASDAQ 100, overtaking Microsoft in market cap. iPhone maker regaining its title as the world's largest stock amid growing optimism AI will spur a rebound in revenue growth. AI, anyone? Pretty exciting. Affirm, again, up 11% yesterday, up another nearly 6%. Related to Apple, that after the buy now, pay later company said its payment products were expected to be available to U.S. Apple Pay users this year. And I got to just mention Tesla, if I can. A lot going on. Stock up about 3.9%. Kathy Wood setting a new $2,600 price target for 2029. Stock closing at $177.
I'm sorry, for what year?
2029.
Okay.
Don't go there.
Okay. I kind of want to go there, but sure. We'll move on.
You'll go there in a robo-taxi,
Let's
Roman,
table it.
whether you'd like to or not.
I'm going to mark this on my calendar right now.
Well, Mark,
little Google alert for
Mark,
5
also
years from
tomorrow on your calendar, because you've got shareholders again, investors voting on that $56 billion pay package for Elon Musk. Over to you.
Okay, so it was just tough to find, full disclosure, decliners with a good story
really
today.
hard.
So bear with me here when I talk about Lululemon down 2.6%. It is in the S&P 500, not the worst performer on a percentage basis in the S&P 500, but kind of up there. They fell, shares that is, after Randall Koenig over at Jefferies said a recent visit to a UK store revealed ample discounting. It adds to the view that performance has peaked.
I've never seen that
competition
anymore.
is rising.
I just bought something from Lululemon.
Well, nothing.
This
And
week.
was it on sale?
No, I paid full price.
You know why?
And I feel like I should return it.
No, you go to the
gotta-
UK.
You got
Buy
to
from
fly
there.
to the UK.
Sure, why
You
not?
got to fly to the UK.
Yeah.
And go to the UK store.
Yeah.
And get the discount there.
Okay. Now, do they let me in?
Ample discounting,
Okay.
at least according to this Jefferies analyst. And I guess that's probably a reason why shares are lower, because there are never sales there. So there's a reason that he says investors should be a little bit concerned. He did say there was significant inventory outside of Lululemon's core colors,
They do
which
have a
suggests
sale
to
rack
him
that's
that
often like these
fashion
off weird
risk
things. Like, I'm
remains
just gonna put
elevated.
that out, but go ahead.
I have not been to a store in years. All right, monthly
Any store?
beverage.
Wow, you're a man of the people,
We're all a
Tim.
little
You just have all your
today.
minions do your shopping for you.
I just order it all online. Yeah, I just order it all online.
You should say they just bring it to his desk every
Beverage
day.
theme for the remainder of my decliners. Monster Beverage down 2.7% today. It actually fell
there's a
intraday
theme.
to the lowest going back to October 24th. We saw Roth MKM analyst Sean McGowan reducing his price target from $59 to $56. It reflects the concern of slowing growth for its U.S. core energy drink sales, as reflected in recent Nielsen and Circana scan data, according to the analyst. Actually, a similar story over at Celsius. This was a recent decliner for me, down another day. Fell earlier in the session, more than 5%. 2%, ended up finishing the day lower by, more than 6%. This was its lowest intraday in months. Analysts reduced their estimate for the energy drink maker after it said at a conference on Tuesday that PepsiCo further reduced Celsius inventories. They are, of course, a distributor for Celsius.
I see your theme. I get it. You got sports, you got the sports beverage, and then you got the energy drinks. I got you, Tim. I got you.
Thank you, Alex.
Let's take a look at the bond market here. No surprise, you saw buying all across the curve. You have yields lower. Now, when CPI came out, we saw a big move lower in yields, a gap down by about 14 basis points on the front end, and then now we're kind of half round tripped back up to yields just down by about 7 basis points. But it's been a pretty monster rally for the bond market over the last few days.
Yeah, the big moves to the downside on those yields now, it raises the question here as to just how much of Fed easing the market will feel comfortable pricing in. And there's still a little bit of a disconnect between what we saw on the dot plots and what we're seeing right now, both in the bond and in the options market.
Yeah, not like we've never seen that before. All I would say is that we're going to get more data points. We're going to get Fed speak. And I do feel like, Scarlett, we're going to start seeing things kind of, jump around. We've heard this from our rates team here, that a lot of volatility. I mean, this is what we've seen in the rates market, and it's probably going to continue.
So now that they have one rate cut projection in the dot plot, are we in agreement here that September is the only logical choice? Because it can't be anything after November, right?
I'm not gaming that. I have no idea.
I mean, Ira did say that waiting until after the election and
yeah, because isn't the Fed meeting right after the election? Like
November
after
7th.
or something?
They moved
Yeah.
it to Thursday as a result of the election.
Oh, it's a Thursday.
So it wouldn't actually fall on election day.
Okay.
But Ira Jersey just said to us, waiting 6 weeks after when they should actually do a rate cut in the greater scheme of things is not actually that big of a deal.
Yeah, particularly if it's just like a 25 basis points, right? I mean.
Well, I think then that goes to the point. Do you get one, and then you get a bunch of them coming after in different meetings? Or do you wait for a longer period of time? Or do you do one and then you have a big gap? Like how that structure looks. The ECB is doing the one and a gap. What does the Fed wind up doing?
Assuming, too, we have an outcome on that November election.
Carol.
All right.
Yeah.
So
That was a great moment. That was a great silence.
Yeah,
You're like,
thanks,
"No,
Carol.
let's
Thanks
talk
for going
about
so
that, Carol."
dark there. Yeah, sure. Why not?
all right, so let's go to something. We can't really control all of this, but we can report on it. Something that we can kind of control is maybe something we want to get, for our dads that are out there or men in our lives. There's a new cologne. Apparently, it's a collaboration between Pepsi and Chef Bobby Flay.
What?
It's called Smoked. It's a combination, a scent combination of Pepsi, smoked, spice, caramel, citrus, and more. So
What? Who asked for
smoky
this?
and flame fired. You know you want this.
I mean, I kind of do, but still, I'm kind of disgusted by it as well.
Yucky.
Can I be disgusted and intrigued? Is that possible?
Well, do they have like the scent things where you can, put the scent thing in and like put it in the kitchen versus cologne? Like I don't want to.
Okay, there
As
you
in
go.
like an air
Bug
freshener?
someone.
Apparently,
No,
this is
like
more
the-
of a Mother's Day gift for
calling
Alex.
it-
No,
than a
like the
Father's
sticks.
Day
You
gift.
put a stick in the liquid and then it has the
You want
scent.
to put this on your body? You want to smell like Pepsi?
I don't. That's why I want to put it in like a air freshener
No, there's
thingy in the kitchen.
spice and caramel and citrus.
I was just reading the other day that Dr. Pepper actually overtook Pepsi. as the
I
number
read that
2
too,
cola
yeah.
brand.
Yeah, it's huge, right?
So, is this Pepsi's last gas beer? I wouldn't mind smelling like Dr. Pepper.
Really?
Yeah,
You
or
are
Fanta.
one weird dude.
No.
Remember
No to
Fanta?
all of
I don't
that.
want to smell like any
Yeah.
of this.
Yeah.
Can we go
Why
back
not?
to Lulu shopping?
Wait till tomorrow's show, Alex. I'm going to reek.
They're going to be sending us bottles as we speak. All right, guys, that is a wrap. Our cross-platform coverage, our Fed Day cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. We will see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television, a deeper dive into the Fed decision and a look ahead to maybe where this economy goes. Former Fed Governor Betsy Duke going to be joining us, and a conversation a little bit later with Jim Chanos. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
I'm Alex Steele.
And I'm Romaine Bostic. Let's take a look at how markets ended the day, and surprise, record highs here on the day. The S&P 500 closing out back above that 5,400 level, a 0.9% gain here on the day. But you take a look at the big drop that we saw in Treasury yields. In fact, it was a bigger drop at one point, almost double what we saw, but still down about 8 basis points here on that rate Fed-sensitive 2-year yield. And that actually put a bid under a lot of those rate-sensitive sectors. That includes home builders as well as some of the banks. Alex?
All right, let's take a look at where the real action was in the equity market, though. Guess what? It was tech, record highs. You got Apple, you got Oracle. So Oracle's story at a record high, monster outperformance after they reported their quarter yesterday after the closing bell. It's all about those partnerships with AI that really is fueling their AI cloud growth. And Apple, I mean, another record high after another record high. Here's the stat, up 14% in 2 days, up 32% since the low that it hit in April. A big move, Scar.
Yeah, I heard you say record high at least 3 times, which brings us to our top story this hour. Short selling is kind of a bad business right now. You can chalk it up to the relentless bull market in risky assets, regulatory threats, and retail traders bidding up meme stocks. So where does that leave the future of the long-short equity strategy? We're going to put that question to legendary short seller Jim Chanos, who famously bet against Enron before its collapse. We'll get his take on whether he sees parallels to past bubbles and what corners of the market look overvalued. Romain?
All right, well, let's go back to that big Fed meeting today, a big decision by the FOMC, a big press conference by Jay Powell. Here's what he had to tell the audience.
We see today's report as progress and as, building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time. And we have to deal with that uncertainty around data. The policy is restrictive and is having the effects that we would hope for. We think we're getting the things that we would want to get, broadly speaking. Rate cuts that might have taken place this year, take place next year. We'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks. Really, the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions.
The chair of the U.S. Federal Reserve, speaking a little bit earlier. Joining us right now is former Fed governor and former chair over at Wells Fargo, Betsy Duke. Getting your instant reaction here to the news today. There were kind of 2 components to this story, Betsy. The change in the dot plot here and where they see rates going, and a lot of debate right now about the neutral rate.
I think there is a lot of debate going on about the neutral rate. The interesting thing, everybody tended to back up their expectations of of what was going to happen in 2024 rates by about 25 basis points. But it looks like they still expect to end up at the end of the forecast period at 3.1%. They did move up the long-term expectation about 2 ticks, I think. Yeah. So that there is some movement on where the neutral rate is.
Does that matter? And not so much for the Fed, but I guess for markets. This is the second straight increase we've seen when it comes to those long-term projections on the federal funds rate. And that seems to be dominating the conversation a little bit more than that chart we were just showing, which, of course, is that drop in the dot plot.
That actually matters a whole lot more than whether somebody wrote down 1 cut or 2 cuts at this meeting for the end, from now till the end of 2024. It's the long term, it's the destination that's going to determine the path of rates. So right now, it looks to me like there's a consensus when they do start decreasing rates, that'll likely be, I estimated at 25 basis points every other meeting. You don't know when that's going to start. They seem to have a sense of where they expect inflation to go based on the level of tightness that they think they have right now. When I looked at the inflation projections, those were all pretty much together. Somebody talked earlier about why didn't the report this morning move that a lot. You always have to remember you have 19 participants using the input of the economic staff at the Federal Reserve Board and the economic staffs in all 12 reserve banks. So you have all of that input, not necessarily going to be moved much by one single print.
So, Betsy, that means that you think that they'll do a mix of sort of push back the start date and then once they go, pause. So the ECB is clearly like, we cut and then we're going to wait for a little bit. You see some kind of median ground for that. Is that the right way?
So the conversation in the room isn't quite like that. The conversation in the room is more, you might have, I might believe that I think we're going to see inflation move sideways, up a little. I'm worried about, Jay Powell keeps talking about the second half of the year and what the prints were the second half of last year and how that might compare this year, the difference between this year and last year. So there seems to be some concern about that. But I might think it's going to take a little longer for inflation to come down. You might think it's going to take a little less long. And we may have a little bit different idea of where rates should be at any given rate. But what happens in the room is it's the sort of center of gravity shifts pretty dramatically. The place it's easiest to see that was last December when everybody took their rate increases off the table.
When they do eventually start cutting, do you think it's going to be because inflation truly is, the trend has been there for whatever, 2, 3, 4, 5 months? Or is it because the weakness is too much in the economy? What do you think they focus on first?
It's going to be when a significant majority of the participants in the room believe that inflation is indeed on a path to come down towards 2%. And I don't think you're anywhere close to that now. The second piece is I don't see much argument for cutting rates other than inflation is coming down. They're looking at growth for the next 3 years through the entire horizon above potential. They're looking at unemployment historically low, very low, not getting over what they consider the long-term level. And, inflation just kind of gradually, barely making it to the 2% target by the end of the 3-year projection period.
You said a move will come when a significant majority of Fed officials see what they want to see. Which individuals would you be paying attention to? We know, of course, Jay Powell's every comment will be dissected, but following him, is it the New York Fed leader, John Williams, or is it going to be someone more like Chris Waller or Lori Logan, who is seen as, a very market-savvy Fed official?
I don't see it as being any individual. I see it as being more probably the centrists in the room have the biggest impact on that, because there are going to be some that are always skewing in one direction or the other, but the very central majority, when they start moving in one direction, that's when you really change the direction of the committee.
Okay, I ask because I just wonder how we're going to get through the next couple of months, whether we're going to be trading off every single data point, inflation data point, unemployment data point, and every Fed official comment, and which one we should pay attention to. Given all that, as a former chairman of Wells Fargo, if you were leading a bank today, how would you plan for what's to come in the coming months?
I think I would look at it a little bit longer term, because the closer you get to the end of 2024, the shorter your time horizon is on those. So, 1 or 2 cuts in a 12-month period is a whole lot different than 1 or 2 cuts in a 4, 3, 2-month time period. So I would be looking now really through to the end of 2025 and judging where rates are likely to be across that time frame, not so much whether the cut's going to come in September or the cut's going to come in December, or even if it's going to come in January.
Well, whatever that marker ends up being in time, Betsy, is it important for Jay Powell to have full unanimous consensus on this, or can we sort of handle the idea that there might be a couple of folks out there? Remember, we have 4 today who didn't even want to cut at all this year.
So the fact that they wrote their dots down at a certain place is not the same thing as being absolutely opposed to something different than that. When you have dissents, it's generally when there really is disagreement about what there should be, and there is, again, a center of gravity, and in particular, an agreement amongst usually the vice chair of the Fed, the chair of the Fed, and the president of the New York Federal Reserve Bank, who is the vice chair of the FOMC. Those 3 really put together what the alternatives are going to be, but they're not going to want to make a move unless they're pretty confident that the majority of the people in the room are going to be on board with it.
All right,
and you very seldom see governors dissent, and even with the presidents, at any given time, you might have a couple that are doves, a couple that are hawks, and a couple that are in the middle. So
yeah,
I expect them to be pretty close to unanimous.
All right, Betsy, going to have to leave it there. Always wonderful to get your insights on a day like today. Former Fed governor and former chair over at Wells Fargo, Betsy Duke, there helping us break down the big news out of the FOMC today. Meanwhile, back here in the U.S., in the markets, the earnings season continues to roll on. Earnings out of Broadcom crossing the wire, and the shares rallying hard here in after-hours trading. Their 2Q adjusted revenue numbers up 38% in the most recent quarter. Top and bottom line beating estimates, and its forecast for the full year of $51 billion, pretty much in line with what the street was expecting. The company, with the shares now trading at about $1,600, also says it's going to pursue a stock split, 10-for-1.
Yeah,
Scarlett?
the latest tech company to do so, right? We're going to see how many others do that. It makes it certainly more accessible on the per share level for retail investors. Coming up, the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Jerry West. The former LA Laker player and executive has died at the age of 86. He is regarded as one of the greatest players in NBA history. And his passing follows the death of Bill Walton and Chet Walker, as well as some other NBA legacies. But, you know, even for people who aren't big-time NBA fans, and Alex, I'm looking at you, you know Jerry West because his likeness is there in perpetuity. His silhouette is the NBA logo.
Yeah.
Oh, you're right. I do know.
You know,
him.
the guy who's kind of dribbling, that's him. It was based on him.
I did not know that.
Yeah.
Oh, that's really interesting.
That's his legacy.
I have zero segue for this, but let me get to this one. Joey Chestnut, the 16-time winner of Nathan's famous hot dog eating contest, has been banned, guys, from this year's competition. The reason was reportedly because he signed a marketing deal with Impossible Foods, a plant-based food company that sells meatless hot dogs. Can I just say, this feels like a really big win for Impossible Foods, because it basically, you had Nathan Hot Dog saying, you're working with a competitor, you can't do our thing. And that just sort of says you're a real threat, like you're a real company, you're a real threat to our hot dogs. Yeah.
So when do we get the Impossible Foods hot dog
There
or
is
hamburger eating with Impossible Foods?
Oh, contest? No.
Yes.
But they have the hot dogs.
I mean, why else would they sign him up, right? I mean, this guy he's the GOAT, right? It's like Wayne Gretzky, Michael Jordan, Joey Chestnut.
Has he won like 4 times in a row?
Is that his real name, Joey Chestnut? Or is that his stage name? Like, is he like a wrestler?
That would be like, you know, like Joey Dog or something, right? Because like
our producer says
Joey
it's his
hot
real
dog.
name.
Yeah.
So I'm inclined to
You
believe
can't make that up. Also, why would you go Chestnut if
I
you're
don't know.
eating hot
It
dogs?
just sounds like a good name, a good stage name. You know?
All right. Well, here's another real name, Andrew Leff. Remember him over at
yes.
Citron Research? He's back in the news, throwing in the towel on his GameStop short position. He actually claims that he made money and he's moving on, but says that there's really just no juice left in trying to short the stock right now. He basically kind of says the company's actually got a lot of cash, not necessarily making any sort of a bullish call on it, but basically saying that, look, you know, just time to move on.
You know, he said the company's got $4 billion in cash. They have a fervent supporter in Roaring Kitty or FN Deep Value, however you want to call him, Keith Gill. And then he says you've got to respect the markets, even if the markets axe bananas sometimes.
Yeah, I just love how social media just lit up, particularly on the Reddit boards when they saw this. I mean, they think it's some big win that they're being able to dunk on Leff that he left, but
they're claiming victory.
But this gets
they've got rocket ship emojis blasting off.
Oh, is that it? Yeah.
I was going to say, but this gets to the point of it's really hard to short stocks.
Yes.
And it's really hard to short stocks that maybe you should be shorting. Like, what is GameStop's model? I have absolutely no idea. But
they have one big influencer talking it up.
Right. So if you look at it, that would make sense to short it, but you can't because of that point. So what do you do if you're a short seller?
Yeah, these are all good questions. And fortunately, we have the right person to speak with about that. Because coming up, we're going to speak with legendary short seller Jim Chanos, president, managing partner, and founder of Chanos Company. You know him. He shorted Enron, and then it turned out to be, well, I don't want to say fraud, but it didn't work out so well.
Oh, no, you can say it.
It was a fraud. Absolutely.
This is The Close on Bloomberg. For years, the Federal Reserve's policy of lower rates for longer helped fuel a bull market in stocks. And even now, after the Fed's rate hike campaign to fight inflation, the bull market keeps on running. It's all raising questions about the future of short selling. So here now to share his perspective, I'm pleased to say, is legendary short seller Jim Chanos, president, managing partner, and founder of Chanos Company. Jim, great to see you here in New York with us.
Thanks for having me.
You look at the number of short buys hedge funds as tracked by HFR, and it's fallen dramatically from 50-something to 14 now, 50-something in 2008 and 14 in about 2023, 2024. How much does the rate environment overall contribute to the shrinking universe of short-selling funds, do you think?
Well, I think the rate environment is probably the first or second derivative. I mean, it's really the ongoing persistence of the bull market, which has now been 15 years. And we saw something similar, Scarlett, in the late 90s, where the number of short biased funds by 1999 and 2000 really had dwindled to a handful. And people just got exasperated. And that was right before there was really 10 years from 99 to 09 of just fantastic returns on the short side. And 2 bear markets, of course. But I think that really it's the length of time beyond just Fed policy, although Fed policy certainly had a lot to do with it in the last 10 years.
Now, I introduced Chanos Company. It's now a family office and advisory instead of a hedge fund firm, right?
Yep.
You are investing in the market, though. I'm curious how you're investing in the market right now.
Well, and we're advising clients. Look, I mean, I just advised a client on a put basket strategy this afternoon. And right now, what we're seeing in the universe of companies we follow is probably it's as attractive a time as it was in first half of 2021. And I've said publicly that 2021 was the most speculative market I've ever seen in my 45 years of investing. And we're getting back to that. Not quite there, but it's close. And you've seen it with things like the meme stocks again. And my God, we're starting to price SPACs again. I noticed that it was $3 billion of SPACs priced.
Does that give you agita, particularly the run-up we saw in GameStop? And yeah, I mean, SPACs are somehow trying to claw their way out of the grave.
People have always said, well, what about the Fed, per your first question? And I always said, well, give Wall Street enough time. The Fed is not the only one with a printing press. Wall Street does a pretty good job at issuing pieces of paper when people really want them.
I mean, how do you sort of navigate? And you talk about advising folks. You're advising people on a public market, public equity market, at least right now, that is at record highs, at least on the S&P and the NASDAQ.
Yep.
A lot of people would look at historical valuations and say, we're stretched here. What is the advice you give in that situation?
Well, since really the mid-90s, we ran our business where we were long equity markets, we were long indices, and then short our names. And I still think that makes a lot of sense. And where the stock market is going, I have no idea. I started my firm back in 1985. The Dow was 1,300. So I mean, that should tell you something about timing. But the fact of the matter is that with the exception of the far right group of companies on the bell curve, most companies underperform the stock market over time or fail. It's the NVIDIAs or the Teslas or whatever on that far right end that go up quite a lot that give you your returns. So the strategy of being long equity markets broadly and short idiosyncratic names, I still think makes a lot of sense. And then finally, insurance is really cheap right now. I mean, people insure their homes, they insure their cars, they insure their loved ones. It's pretty cheap right now to insure a portfolio.
Is AI in a bubble?
I have no idea.
You lived through bubbles. You lived through.
I've gone through bubbles. I'll make one observation as it relates to AI. So if you go back and look at the U.S. economy in the immediate post-internet age, and I think we can all agree the internet changed our lives in a major way. From 1998 to 07, the U.S. economy grew at 3% real annually. From 1988 to 1997, the 10 years prior to really the advent of the internet to the public, the economy grew by 3% annually. The internet had no impact on growth. Now, it had a lot of impact on individual companies, getting back to my point, right? There were big winners and big losers.
Right.
And I suspect if AI is going to be as transformational as people think it is, and I have no idea whether it will be or not, there'll be big winners and there'll be big losers.
I just want to follow up on that, though, too. And this kind of leads back to the question Scarlett started off with about the connection between macroeconomic conditions and our markets today. And there does seem to be a disconnect.
Yeah, I wouldn't disagree with that. And I think there's a much more speculative nature of this market. And we started to see it in late 2019 when commission rates got cut to zero. And retail began to come back in the market in a big way, in ways they hadn't been in. Prior to that, they'd been investing in ETFs or mutual funds or what have you. And we began to see pre-pandemic speculation in individual names really pick up. And then, of course, post-pandemic, it took off. And we're still, you can see it in option volumes and a lot of other sort of quantitative measures that the public is in this stock market in a big way. And that really then means that you have to change your risk parameters, change the size of your short bets, if you will, and be mindful of the GameStops and those kinds of things. On the other hand, generally they chase momentum and sometimes, quite frankly, silly stories. And if you want to be investing, you don't want to be doing that.
If you were looking at the AI story, and I get you can't say it's a bubble, but it's spread out in lots of different parts, right? Utilities have been up, power has been up, you have hardware coming up, you got software, like it's like the tentacles are moving out.
Right.
How do you think about something like that? Like how do you?
Well, we look for, I mean, for one, we look for companies in our world that have gotten the benefit of an AI, kiss, but are actually going to lose because of AI. So we've been publicly short the data centers, the legacy data centers, because they literally are not designed for AI chips. They have to basically be retooled completely. And all of the infrastructure and hardware in a data center, an old one, is not compatible with the new chips. So people have bid the stocks up thinking they're AI plays. They're actually losers from AI. And it gets back to the winners and losers thing.
We mentioned SPAC companies a little bit earlier. I'm wondering if you're trading around the elections at all. What might a Donald Trump victory in November, for instance, mean for regulation? And would that, as a result, perhaps create more opportunities to be short companies? Because, with the regulatory heat taken off, companies can do all kinds of things, and speculative fever goes up.
Yeah, I mean, it's hard to bet based unless you know who's going to win.
Yeah.
It seems like I still think it's going to be a pretty close election. And obviously there's certain areas that each party would emphasize and de-emphasize. Again, some areas that we're already negative on, like solar, would probably lose under Donald Trump. But it's hard to know exactly, particularly if the polls are right, that it's still a pretty tight election.
Yeah, and of course, he's a booster for all kinds of companies, including his own SPAC. You've been very vocal about how irrational retail day traders are. How much can a charismatic influencer like Roaring Kitty, aka Deep Effing Value, and what's his actual name, Keith Gill, and an army of day traders keep this GameStop dream alive? I mean, from where you sit and looking at it, at some point it comes crashing down, does it not?
Well, it already has. I mean, so if you look at the meme
But
stock,
there's little blips here and there.
Yeah. But if you look at the meme stock class of 2021, which was GameStop, AMC, Bed Bath & Beyond, a number of others, I mean, with the exception of GameStop, they are all down 90, 95, 99%. It was disaster for retail investors, quite frankly. And so I think that it gets to my point that you don't want to be chasing this stuff if there's no fundamentals behind it. And I have no position in GameStop, but people are still valuing that company, if we're going to value a business, at 3 times its cash. And even though it's raised all this cash, it's got about $9 a share in cash right now per share. I think the stock's at 25 or 26 or 27. And so you have to believe the business has something, or there's option value to the cash, which is what people believe, that Ryan Cohen will be able to do something. That's really hard to do when you're paying $3 for $1 of cash. And again, so you're chasing the future, you're chasing the story. In bull markets, the future gets a premium. In bear markets, reality gets a discount.
Well, when we talk about that premium, particularly when it comes to GameStop and some of those meme stocks, let's talk about potentially the other side of that trade, which is sort of the short positions. We saw that in 2021 where the short interest went through the roof. We're not seeing that necessarily as aggressively this time.
It's the opposite.
But part of that reason is because there aren't a lot of folks like you doing this anymore. A lot of those folks got scared off. Obviously, we know what happened to Gabe Plotkin, and a little bit earlier, we were just talking about Andrew Left, who had a short position in GameStop, but even he closed that out.
Yeah, well, again, we can just look at the numbers. Overall short interest is down, as you allude to, but take a look at GameStop again, just use this example. So a week or so ago, 10 days ago, short interest was 22% of the outstanding or of the float. Today it's 11%. A, the short interest went down. B, they issued a lot of shares. Getting back to my point about issuance. So the supply increased, And now the shares are, so now it's not a short story anymore. The shorts aren't trapped. In January of 2021, I think the short interest was 140% of outstanding.
Yeah.
And now it's 11. It's a big difference.
Okay, so that maybe that's not a target. Is there sort of a market, or more importantly, appetite for that sort of short seller's playbook, a playbook that you made famous? And it just doesn't seem like there are sort of new Chanoses coming around the corner in this space anymore. How do you feel about that?
I don't know. I you know, after 45 years, I don't wish that on anyone, maybe.
But for the people who like want to aspire to that, right? Like, are there players in the market?
There's some really good. There's some really
good?
good people on the short side out there that are doing great work.
Like who?
Like the folks at Hindenburg, I'm a big fan of, and others. And you know, we never did the short activist model, but the work they're doing is I think, you know, the fundamental work, which is what I look at when I look at people's work, is really first rate. And so it's out there. And I've called this the golden age of fraud. So there's just so many companies, so many companies now that are playing games that are trying to take advantage of investors. So we need short sellers more than ever.
We need short sellers more than ever, but the government's cracking down on all of them, right? This ongoing investigation into activist short sellers has resulted in its first charge. I believe Anson Funds and Anson Advisors
I saw that today,
were accused of hiding payments to bearish researchers.
It was a disclosure issue, really.
It was a disclosure issue, but it's something, right?
Yeah, I think that was the issue, and we were never involved with that, and that was never part of our business model. But I think that the issue that the government was worried about in the SEC and possibly justice was disclosure. Were there people funding these things that was not disclosed that should have been? I could argue that legally, but I think that was really what the issue was were there third parties involved in funding this that should have been disclosed or not? Yeah,
it goes back to that idea that there's a lot of ways to make money. Short selling is complicated, it's expensive, and it's certainly a risky way because your downside is unlimited. You shut down your hedge funds last year, yet given where we are in this market cycle, you say we're in the golden age of fraud. This might be a good time for short strategies in terms of performance. Do you see it getting a little bit easier to raise capital from institutional investors for short strategies?
It's harder.
No?
Yeah, and that's part of why the opportunity set is there. Nobody wants to do it. And so I think that's what's so interesting. And of course, you had the growth in the platform companies, the so-called pod shops. So a lot of short selling is done through those vehicles in terms of dollar value. They've certainly supplanted the long-short world in a major way. But with tighter risk models, so we see more volatility sometimes because those platform companies keep short positions small, and if they move against you a certain amount, you're out. But by the way, that works on the long side too.
But do you think, though, that long-short strategy might actually have some value at some point in time?
Oh, absolutely.
Because, I mean, we talk about this idea. I mean, you can't have a market that's all long. I mean, that doesn't work forever, does it?
I don't think so.
Okay.
And as I said, we have 40 years of almost of numbers that kind of prove that wrong. Yeah. In pretty much straight up market. So I think that again, as long as you're doing your work and don't focus on the short term and understand that a dollar is not worth $3, right? And you shouldn't pay $3 for it. And if you can sell it for $4, that's maybe not a bad trade. I think there'll always be room.
I was having a conversation with a long-short manager, and she kind of pointed out this idea of, at least in her mind, that price transparency or price discovery was not as easy as it used to be. So that made the strategy a little bit harder. And she pinned some of that on the distortions coming out of the private markets. The idea that private markets have stolen a lot of thunder from public markets. You don't necessarily have the same balance or equilibrium in private markets in public markets that you had in the past.
I mean, that's an interesting theory. Yeah. I have not considered that the private markets would impact the short side in that way. I mean, I think the private markets, the growth in private markets has had a lot more to do with capital raising, particularly in the public market arena, including long short. I sit on a couple of investment committees, and we've been doing nothing but redeeming hedge funds and giving it to private equity, private credit. And in my own view, I think that's not the right thing to be doing right now. I think that wherever you see a flood of money for years and years and years, it's been pretty much, you're not going to get the outsized returns that you had 10 or 20 years ago.
Jim, let's circle back to individual stocks. Why don't you like solar stocks?
I don't like solar stock. I don't like the residential solar stocks because the business model doesn't work, no matter what rates do. the concept of putting up panels on someone's roof and then leasing it from that company. If you just look at the numbers of the companies that are in that business, like Sunrun or Sonova or whatever, they bleed cash, and they use accounting constructs to tell you why it's really economic, and meanwhile they're just burning hundreds of millions of dollars per quarter, and have been for years and years and years. And I think that is just simply an accounting story.
What else don't you like? You laughed. I mean, like, it's interesting to get your take, because solar stocks have been on a tear. Like,
yes, well, the last couple of weeks.
Yeah.
They were actually hitting new lows just last month. And so they bounced because of the view on rates. We're not going to talk about the Tesla shareholder vote?
Well,
Yeah,
actually,
yeah.
Well, let's hear it.
I was slowly rolling
She was,
into-
she's,
I was
you
setting
know.
you up. You're taking away my thunder. I asked you that.
I was waiting for someone to come up behind me. We don't like the data centers and haven't.
Yeah.
We've been public on that for a long time. I'm puzzled by the number of restaurants that are trading at absolutely insane valuations in an industry that, ultimately is not a secular growth business. You can find stocks at 50 times cash flow and 100 times earnings. And there's lots of companies that are kind of mundane that have been bought by growth managers where the returns on capital are low, that are trading at 50, 60, 70, 80 times earnings. You can find them. There are a lot of them. And so it's a pretty target-rich environment right now if you're doing fundamental work.
Okay, now
I'm sorry,
Scarlett
did
can
he
ask
answer the
Tesla.
question on Tesla?
No,
Scarlett
we're
The question he
getting
asked
into it.
himself.
Yeah. Well, Tesla is holding its annual general meeting tomorrow, and you were famously short Tesla at a time when it basically defied gravity. We know that shareholders are going to be voting on Elon Musk's $56 billion pay package, not from this year, not from last year, but from a couple of years ago.
Yep.
What is that emblematic of? What does that tell you?
Well, first of all, it might shock some of your viewers, but I tweeted out a week ago, I actually think that people should vote for the package.
Really?
I think, even though I'm a bear on Tesla, I think a deal is a deal, even if it's a bad deal. And they agreed to it. Now, the judge even if they voted in again, doesn't mean it may happen. It may not obviate the ruling. But I do think a deal is a deal, and that if you voted for it, that he should get it. Having said that, the value of the package is in excess of all the retained earnings of the company's ever made, even post-package. And the one thing I pointed out today, the one thing I've been scratching my head on and going back and looking at this package from 2018 was that the deal was contingent on hitting certain numbers and the stock price hitting certain values. But what they didn't do was make each tranche the new equity award that he got for doing that, the strike price of that option at the stock price at that moment. All of the equity for all of the tranches was set at the original price, which was $23, adjusted for the split. So that means there's really no clawback provision, and basically it means if the stock goes up a lot and then goes down a lot, he still wins. The shareholders don't necessarily win. And in fact, I think the stock price is below where he earned the last tranche already. So it's a little bit like a hedge fund manager saying, okay, well, I was up 40% at mid-year and then gave it all back in the second half of the year, but you should compensate me on the fact that, I was up a lot at one point.
Yeah.
And so that's the one aspect of the package I think shareholders should really, be kind of kicking themselves on. I think that the tranches should have been set at each point at which the stock price had to go to. But having said that, I think he should get it. I'm not a big fan of Elon. There's no surprise of that. But a deal is a deal. It is, however, a very expensive deal for the shareholders. And what does it mean about going forward? What's going to be the next demand?
Do you think it would be better, though, if they structure? I know they can't really restructure, or they can, but if they tried to restructure it, would it be better to sort of make some of those metrics tied to the performance of the company itself, not necessarily the stock, but I'm talking about sales?
Yeah, it was both.
Yeah.
So the award was tied to both, and there was various formulas. Look, anytime you tie it highly to stock, it's problematic because you run the risk of someone being overly promotional to get paid, and then worrying about it later. And I've often said that lavish stock option programs are undervalued in the marketplace in terms of their expense, because if you have a board that's very acquiescent, and that's Tesla, and you don't get fired for aggressive, risky behavior, if you engage in risky behavior to get lots of stock option payouts and it doesn't work, it actually becomes in your self-interest to have the stock price go down so you can reload at lower prices. So in effect, when you've issued call options to an executive, in that case, you've also issued them put options. And a lot of people don't realize that. And so I think that it makes share-based compensation problematic for that reason, and also for the reason that everybody simply adds it back for adjusted earnings, which is another accounting game being played.
Yeah, rumor gap. Cool. Those were the good old days. Jim, going to have to leave it there. A great conversation here with Jim Chanos, the president, managing partner, and founder of the family office and advisory Chanos Company. All right, we were just talking about that Tesla annual meeting taking place tomorrow. We're going to set you up for some other big things to watch over the next 24 hours. This is Bloomberg. As we come off a really busy day here, a busy Fed and CPI day, here are some of the big market moving events over the next 24 hours. And we start overseas in Italy with the G7 Leaders Summit.
Apparently, they're going to watch a skydiving demonstration and then gather for a family photo. I mean, they're going to discuss other issues like Ukraine, but I always like the ceremonial parts of it because, you know.
But why the skydiving? Is that a thing?
I don't know, but I know President Biden will be watching it. Yeah, maybe. It's a bonding moment.
Oh, they're not skydiving.
No, that feels wrong.
All right, and then we come back here to the U.S. We do get fresh economic data on inflation, this time on the producer side, Alex.
Yep, and also initial jobless claims, so definitely watching that as well. So you get a little bit of growth, you get a little bit of inflation going on there.
Yeah, but I feel like the world is right again with CPI first and then PPI. Last month it was the reverse. It was a little bit, head-boggling.
Yeah, we just got to put CPI ahead of the Fed meeting next time. So we have some separation here. And of course, the big Tesla annual meeting we are going to get tomorrow as well. And we get earnings tomorrow as well after the bell.
We're getting Adobe, right? Restoration hardware. Adobe should be interesting. It's really about the AI in video. I'm reading that's a big key.
Yes. And how much people are really picking up on that and whether enterprise customers are really subscribing to that.
Yeah, do you have these suites at home? We have the Adobe suite at home, and they've been trying to really kind of sell us on this idea of all these new AI tools.
I avoid AI.
And that's like more money.
Yeah,
so
of course.
I'm kind of against that.
I'm against recurring revenue and subscription fees, unless it's for HBO, and then I'm
so
like,
why do you hate our economy, Scarlett? Our entire economy is just recurring revenue at this point. All right, and Alex, I know this is going to be your favorite event, and you're keeping an eye. The start of the 124th U.S. Open Golf Tournament. Who you got?
Sports. Who's playing?
Maybe Joey Chestnut.
Sheffield.
Joey Chestnut on the golf.
Wait, no, is there a player named Sheffield?
Scotty Sheffield.
Okay, see,
yeah, there you
I actually
go.
watch golf on Sunday with my dad, so.
All right, well, be sure to tune in tomorrow here on The Close. Alex, Scarlett, and I will be back for all your market moving coverage. In the meantime, stick around. Balance of Power up next.